Hey everyone, this is Richard Yi. Today is November 2nd, 2011. So yesterday, the Department of Treasury actually came out with a report saying that it estimates in the next 6 months, Department of Treasury will sell 846 billion dollar worth of treasuries to the market, and that is a 35% increase from last year in the same period. And ladies and gentlemen, this is the direct effect of raising the debt ceiling 2 months ago. Because remember, back then, you have the debt ceiling in place to force the government to come up with a solution with its debt problem, either to cut off its deficit or to sell off some government plans to the private sector to raise cash to pay off those interest occurred on those loans. But now, since the debt ceiling is raised, you don't have that kind of constraint anymore. Well, at least for a while. But therefore, the government can just having the Treasury Department to issue new Treasury bills and raise capital that way. And what's with this 35%? I mean, in just 1 year, the U.S. government has to borrow 35% more in 6 months, just to sustain itself, basically. And yet, we have those GOP candidates on the stage debating who's mowing whose lawn. I mean, the U.S. is in a serious financial trouble right now. I mean, this year is 35%. Who knows what percentage is going to be next year? Maybe 35% square. Who knows? And in the future, the value of dollar will definitely depreciate against other hard assets such as gold and silver, just simply because their supply cannot be increased. They're fixed. However, against other currencies, I mean, dollar might not, in a depreciating position against other currencies because we're now in a stage of global currency competition of depreciation. Just like every central bank around the world are trying to depreciate their currency as hard as possible, in an effort to possibly boost their exports, well, which not won't really help. But just for instance, last week, Japanese central bank intervened in the foreign exchange market and pumped almost 7 trillion of yen in the market just to drive down the value of yen, because the yen, had lots of appreciation against dollar last week. Just look at the charts of gold and silver. In the past few days, they have both been picking up momentums just to compensate the loss in value of other fiat currencies. But it's also very important to look at the global picture because likely the Fed is not going to buy 100% of those treasuries. Other nations like China, Japan, Great Britain, Brazil, Russia, those countries, they all hold large amount of foreign dollar reserves. And there's nowadays there's not really many good places to park this money. Um, you can't just really lend them to European Union because they're in deep trouble right now. I mean, lending money to them is just what, jumping into the fire pot. But and you can't really buy much gold because if you're gonna buy gold, you're gonna push up the price of gold. Furthermore, I mean that definitely is a wise move, but to those central bank governors, they definitely don't want to see the price of gold just go up like rockets due to their actions. So, I mean, the only reasonable place to park their dollars is just loaning them back to the U.S. government. So, I mean, it's better for them, just letting the cash just sit in the vaults and just depreciates, right? At least you loan it to the government, you get more wasteful paper in the future. But hey, at least you get something, not just sitting there. However, it's also very important to look at what those countries are buying, because, for instance, China just keep buying those short-term treasury bills. I mean, those give China lots of freedom when if the U.S. goes tanked, because when you're holding short-term notes, if you want to get out, you don't have to sell. I mean, that's it. And also today, just hours ago, the Federal Reserve Chairman Ben Bernanke he offered a press conference, and during the conference, he just keeps saying the stuff he said before, which is nothing new. And one interesting thing is he actually said he's gonna keep interest rate low, between 0 and 0.25% till the mid 2013. I mean, can they even make it to 2013? That's the question. Because remember, interest rate means the relationship between saving and investment. So doing a free market, the interest rate tells the businessman how much they should invest, because how much the loanable fund is basically how much the consumers they choose not to consume presently and choose to save this money for those businessmen to invest. And the interest rate tells businessmen how much those money are, and how much resources they have, so they can commit the appropriate amount of investment. But since the state decides to control interest rate, then it necessarily distorts investment and saving, because now in the United States the saving rate is actually negative. I mean, people aren't saving anything, and yet the interest rate is so low that implies there are lots of loanable funds to the businessman, so that they can engage in expansion projects, you know buying laborers to build factories and all that. And what happened is businessmen use this newly printed money to buy capitals, to buy resources in the market, and eventually bid up the price of those resources and capitals, in an effort to increase production to face the future demand. However, since the price of those capital are bid up, and this is inflation, because the money was not saved, it was created, and as businessmen spend those, price level increases. So as price level increases, the Federal Reserve it will eventually cut back on the crazy low interest rates, which will eventually cause businessmen will be hard to get capitals, and their investment are proven to be malinvestment, because they weren't supposed to exist, because consumer saving were really low, so there shouldn't be much investment in the economy. However, since the Federal Reserve drunken those businessmen with low interest rate, they fool them, let them believe there are lots of saving available for them to invest. However, as when they're doing their investments halfway through, and the Fed raises interest rate due to inflation, and what happened is, many of those businessmen start losing money, and they start laying off workers, and the economy kicks back into this depression, and that's what we have right now. So in the future, the U.S. is very likely to face another depression or recession, just depending on the magnitude. And the trigger is when the Fed start raising interest rates due to high inflation in the U.S. Thank you for listening. I will be blogging again soon, guys. Take care. Bye.